So let's talk about one of the more important trading principles for intraday trading, and let's walk away with a really good principle to follow into the close, and then we'll broaden it out and talk about the other two big time frames for trading so you guys can construct your playbook in a beneficial way. So look, lots of people like to fade, right? And that's fine. That's a perfectly acceptable trading strategy. I actually think that's hard for traders right at the beginning. We discourage people from fading things right at the beginning because I think that requires pretty advanced tapering skills, a good understanding of risk reward. They're harder trades. And one of the things that I definitely don't want you guys to be doing, especially at the beginning, is making the mistake of trying to fade the 3 o'clock hour. And we've seen two really good examples of that, which we've talked about in here, but I just want to go over and then expand it out. So on Monday, we had beginning of the month trading, which can bring in new money, right? People have IRAs and retirement funds, and hedge funds get new money in, and mutual funds get new money in, and they have to put the money to work, right? And that can come in beginning of month. So there's this fresh money that comes into the marketplace, and that you want to be thinking beginning of month, I wonder if that's going to get put into the marketplace, and we've been very strong. And so there was, that big 200 level that we were watching on Monday. We cleared it. We had a nice consolidation area into the close. We couldn't trade above 200. We got above it, and what happened? We just ran into the close, right? We went from 200 to 202. The takeaway from that example is to understand that 3 o'clock hour, there's lots of institutional buying that goes into the marketplace, and you do not want to be using your fade strategies except at the most opportunistic and optimal points. Then it is not likely when the market starts to buy into the 3 o'clock hour. It's nowhere near as likely that we will reverse. Okay, I like to think of 3 to 4 as that period of time where if I start to spot a trend in the first 15 minutes, that it's much more likely for that trend to continue. Okay, so that's, in a case like that, I'm looking for longs. And we bust above 200, I'm looking for good risk-reward, long opportunities, looking to see if this will continue until end of day, not in any way thinking the market's going to pull in unless we go find a really, really significant resistance level or there's something new that hits between that 3 and 4 o'clock hour. We saw the same thing the next day. We gapped up a little bit. 204 was a big level, right? Couldn't trade above 204 on the SPYs. Got above 204 on the SPYs. We ran into the close. You want to look for longs. What are some good stocks? What are some good prices to buy it at? How do I control my risk reward from here? Making the assumption that we're going to follow through into the close. We don't always do that, but that's the right side of the marketplace. And as intraday traders, that is a time you don't want to be fighting. You don't want to be fighting the market. Better times to fade are right on the open. Okay, we'll talk about a lot of those trades as we go along, but I've seen a lot of really young guys try and fight that hour and get beat up pretty bad and wonder why. And it's just not, the market structure is what it is. Big people come in at 3 o'clock to 4 o'clock and let them do their thing. If you spot a trend, that's good. Get out of the way of it. Okay. So I'm not a big fan of you guys fading at the beginning, but if we see you fading in that 3 to 4 o'clock hour, we're gonna have a big discussion. Okay, so let's not do that. All right, thanks.